Hello, everyone. Good afternoon. My name is Raffaele Della Croce, and I'm a part of the Center for Climate Finance and Investment, and also part of the Singapore Green Finance Center. We have still one session to go. This is going to be a session on from ambition to reality, how to scale up adaptation and resilience finance. In a way, we close the loop. We started this morning with the Jim Ski emphasizing the need for adaptation. This has been neglected in several fields. And the fact that the next cycle of the IPCC is going to focus, is going to be also about adaptation resilience. And we know about the gap in investment in developing countries. So we know the figures up to 300 billion of needs per year increasing over the next decades. We know about the floods happening in Vietnam last week, in China, in Central and West Africa, which is a bit unnoticed in European press. And of course, we know what is happening in Europe, right? The Boris impact on 20 countries in Europe just a few days ago. And the fact that, as was said this morning, even in the best scenario of the 1.5 degree ambition, reaching that, we know we need to adapt to a different environment. In Europe, we are hitting a double the rate of other countries. So we know we're going to live at 3 degrees soon. So are we ready? We're not. Yes, some positive here. Good. But we're going to get there, hopefully. So that's the positive take of it. The impact of physical risk, of course, has been mentioned also. It's gonna impact in particular the most vulnerable. It's about small islands on one side, but it's part of the population we live here in the UK, in London. The most vulnerable are women, the old people. So there is a problem of climate justice here. And there is also a necessity of security. More and more in the economy, the supply chain disruption caused by climate hazards are evident. And they are a major issue that people are taking seriously. But to link into the previous session, there was a discussion about physical risk estimates, which we know is underestimated for several reasons of measures, data, lacking data, and tipping points, nonlinearity, secondary order impacts, complexities, and so forth. And also the black box, which is about adaptation measures, which is one part of the vulnerability which is not taken into account into modeling today. And that is due to the fact that adaptation is very local, is geographically relevant, is asset specific, and we don't have the large set of data. And that is an issue for research. There is not much research on adaptation. It's an issue for understanding each other. And that is part, to me, of the explanation of why we have this implementation gap on adaptation, which, again, we need to work on. Just to give the context of what is happening in one slide. On the top left side is what I mentioned, the IPCC work, the gap that I mentioned. Financial sector regulators are realizing this, and so FSB and ECB are actually looking into physical risk, as I was just seen before, but also the adaptation measures linked to insurance protections, a sort of incentives discussed at the moment. Beyond the insurance-linked instruments, there is discussion about PPPs models and how to not disincentivize the ex-ante measures of adaptation, which is needed in the first place. It's not just an ex-post sort of reaction. On the bottom right side, so this is a risk management sort of action that we see happening in the market. On the right side of the slide, there is the opportunity that the financial industry is waking up to. And so you call it, the Goldman Sachs, the 400 billion opportunity in adaptation. This morning was a comment by Howden about de-risking the transition, the role of insurers. They clearly have a complementary role between adaptation and mitigation. We see the debt market with issuance of adaptation bonds. This is a very first and nascent sort of instruments. Just yesterday in New York was launched a climate bond, a taxonomy on adaptation, which could be a very important step in getting some standards and definition. And then you have the corporates on the top right side of the slide. I put two UK ones, the National Grid and Southern Water, which have been the water sector has been part of what we're looking at, and the way they look at adaptation, climate adaptation, as part of their strategic priorities. So it's not just on one side, it's part of the operational business, and it comes in different strands between the energy sector and the water sector. So what have we been doing? Well, there's been at the Center for Climate Finance and Investment previous work, and also in Singapore, on trying to understand what is happening in the first place, who are the actors, and why this is not happening, even more importantly. And building on those previous studies, we've been looking at a series of three major questions, looking at the UK and London in particular, but making comparison with other countries and cities. And so a first one was asking what are the investment models and the financial instruments that investors use in adaptation. A second one was looking at the urban adaptation sort of context. And the third one, which is going to be published in October, is going to target the recommendation for policy institutions and financial institutions. And this is a bit of drawing the set of issues that you need to consider when looking at adaptation from the public and private sector for practical use of the case studies, the concrete examples, but also thinking about what is the academic question that we want to answer here. So the first one, just to highlight the three questions that we're gonna ask the panel, was trying to see what are the opportunities now in the market and what needs to be created in the market for investors to access adaptation. And one part of this discussion is about the infrastructure investment needs, which are already planned. In the UK, the National Infrastructure Commission is targeting 80 billion of investment per year, growing from 55, and plenty of this investment is going into retrofitting, into water reservoirs, as we've been seeing on this paper on the Portsmouth reservoir. There are opportunities in maintenance and renewals, and that is also what people see, the technology development, the green tech, the AI uses for digital twins, analytical sort of analysis of this new data to understand the deterioration of your asset at the local level. And then there is a market that is not there. Nature-based solutions are an example. The fact that they're very small, difficult to replicate, the issues with definitions, metrics, we're going to discuss in a minute. The second point was what are the investment models and the financial instruments, which links is not just the channeling here of the investment, the monetizing, the co-benefits that we see in adaptation, such in nature. This is very parallel sort of discussion, very similar happening, but also the deliverability of these models. And that is not just the fiscal sustainability, but also the investability from an investor perspective. And the third aspect is the mobilization of private sector financing, so the drivers that the panel will respond to. Last slide, before getting into the discussion, is the urban dimension of what we're talking about. Clearly, that's where the dimension of the multidisciplinary aspects of adaptation come into light. It's quite striking. London, comparing to Singapore and Copenhagen, lags behind. There is a big push into private sector financing, not much yet happening. Reviews, the London Climate Resilience Review, provided some recommendation just before the summer. And there are other issues which are related to the opportunity that we see in getting into adaptation. In London is the housing crisis, the fact that we need to build new buildings, and those buildings should be fit for the climate that we're gonna have going forward. So the nature of positive city infrastructure, what the TNFD is doing for investors and when look at investment in cities, but also this morning there was the biodiversity net gain Excel spreadsheet that you've seen in the nature finance and biodiversity panel. That is very much a big driver also for climate adaptation. Biodiversity, nature, and adaptation are very much linked. There is the issue of local capability and inclusion. The fact that often the public sector needs to drive this investment and local capability is absent. And inclusion, the fact that people need to know, understand if there are instruments such as municipal bonds, crowding mechanism, people need to be on board and understand why they're doing this. Lastly, green tech role of insurance, just discussed. Plenty happening on the AI side, use of data, big data. Singapore, there is a mention in the paper of a few examples of the way Singapore is going about this. And so plenty to discuss, and happy to get questions on this work and how we're going to go forward, hopefully with the help of the researchers who are interested in this area. So with this, I'll get to our panel, which is a set of diverse stakeholders, I would say, very important one to this discussion. We have here to my right Simon Wilde, partner from Oxera, with a background in regulation in the utility sector, and also as an investor, right? Chiara Trabacchi from the British International Investment, UK DFI, and also an impact investor. Expert on climate, and Luba Nikulina, Chief Strategy Officer at IFM Investor, which is an Australian equity investor in OECD countries, I think. But I'll let you explain where you come from to adaptation resilience from your institution point of view, and if you have a definition about adaptation resilience in the first place. Luba, why don't you start? Because you also need to go early. You have a flight to catch.
It is actually quite embarrassing that I will need to be leaving this panel in 5 minutes, but obviously the discussion was so rich that we are running half an hour late, and I am catching flight to Boston. And my excuse is that I will be carrying the sustainability flag to the US, and we urgently need a strong sustainability message in that market. So thank you very much for the introduction, Raffaele. So IFM Investors, IFM stands for Industry Fund Management, and we invest in infrastructure. We have $150 billion US under management. And the way we were created is actually quite interesting and unique, so I will briefly cover that. So we were created around 30 years ago by Australian pension funds. At the time, there was a significant privatization in Australia of airports, and pension funds were looking at these assets, and they couldn't find a solution in the financial industry that would allow them to take these assets and own them forever in perpetuity, taking the cash yield. So they were looking around and then like, well, we cannot find a solution, we'll create a solution ourselves. So 27 of them came together and created IFM. So we are profit to member model, so we don't need to be earning profit. What we need to be doing is to deliver these returns to our investors. So 30 years on, we now have, as I said, 150 billion and more than 700 clients. Most of them are pension funds. And we own infrastructure in OECD countries, as Raffaele said. Here in the UK, some of the examples is M6 Toll Road, Manchester Airport Group. There is a lot of focus on water sector in the research paper. We own Anglian Water here in the UK, and we bought it in 2007, so we are closing on almost 20 years of ownership, and we are not selling it anytime soon. So of course we are very interested to ensure that this asset performs well, and this is what our model allows us to do, essentially own assets in perpetuity. We have the net zero commitment. In infrastructure, it's actually quite hard because many of those industries are very hard to abate carbon emissions. So each asset that we own has a transition plan. Some of them will require innovation and technological breakthroughs, such as, for example, aviation, sustainable aviation fuel that we also invest in. There is a separate pool of capital that invests in this next generation infrastructure, renewable energy, sustainable aviation fuel, carbon capture. And then back to the topic of adaptation and resilience. Resilience is crucial for infrastructure assets. We are providing public good, public service. So if it is disrupted, then the consequences could be beyond calculation. So it has always been part of the investment due diligence and the way we manage assets. But the thinking around how we invest in adaptation in particular has been changing dramatically in the last, I would say, decade. And this is because the weather, the climate is already changing in front of our eyes, and the losses and the types of events that we are experiencing is again changing pretty much every year. The numbers were quoted in the previous panel. So there are two aspects where there is the challenge and where there is a significant change. The first one is that investing in adaptation doesn't have cash flow associated with it. So you really need to be applying a very different type of thinking when you think about this cost. So you essentially start thinking about avoided losses that you invest into, and it's a different type. So this is where the partnership with people in this room, people who work in this institution, with the work that Raffaele does, is incredibly important, because we need to be changing those models to be calculating the value that comes from avoided losses. There is also additional value, because you can make assets more productive while investing in adaptation, and also create community benefits, which actually allow you to increase the overall value of your brand and your asset. So this is the first angle. The second angle is actually you cannot think about adaptation finance without applying systems thinking. You need to think about the whole ecosystem. I have a wonderful example. We own a port in Australia, Kembla Port, and it's an area prone to floods. So we had invested in ensuring that there are coastal barriers, early warning systems. So there had been a significant amount of investment in this port to allow this adaptation and resilience. Now, in 2022, we had the record flood in Australia, and the port withstood this event. So they continued providing services, so the system worked. But then there was a rail link to the port, and there was a landslide. We didn't own this part of the value chain, and so there was a landslide, so the port stopped anyway. So it's sort of these costs and benefits of adaptation finance, they are really, the way they are distributed, you really need to apply systems thinking and work in partnership with governments, with communities, with your assets and with investors to be able to actually solve it. Otherwise you could incur cost and then not have the benefit. And now I need to go and fly to Boston. I'm so sorry.
So no questions. We will convey your questions. I'm sure they're going to be. Thank you very much.
And there are details. So if there are any questions, please or find me on LinkedIn. And I'm very happy to answer any questions. Thank you so much. And best of luck with the plan.
Thank you, Luba. Chiara, talking about partnerships, how the investors can work with public sector-driven institutions such as yours. What do you do? How do you come to adaptation resilience? And how do you see you working with investors to overcome these issues they see about lack of cash flows, systemic thinking, and so forth?
I hope I have all the answers. So possibly, for those of you who don't know it, British International Investment, as Raffaele said, is a UK development finance institution, and it provides patient and flexible capital to very much enable productive, sustainable, and inclusive development in Africa and South Asia, which are the markets in which we operate the most. Climate adaptation and resilience is very much a key building blocks of our climate change strategy, along with net zero and just transitions, which are key themes that have been discussed during the conference. And this is because we operate in some of the world's most vulnerable countries, whereby the need, but also the investment opportunity for adaptation and resilience is the greatest. Our approach is two-pronged. On the one hand, investing in companies providing adaptation-enabling solutions. With these, I mean those solutions that enable others to adapt, being assets, being people, being corporates. For instance, climate risk analytics, early warning systems to prevent damages and losses, but also, for instance, sustainable cooling, so all those solutions that are needed to respond to climate shocks, such as extreme heat. And we see this in London, but think about Pakistan and India that have been experiencing above 50 degrees centigrade, and this makes very much impossible for people to work and live productively, but also for food to be stored properly and in a safe way, but also very much to recover from climate shocks, and we discussed earlier on the role of insurance on these. Second component of our approach is very much working with our investees to identify, assess, and manage physical risk and invest in adaptation and resilience solutions, which may be soft measures, i.e. very much related to management and process and procedures, but also hard measure, very much changing practices, changing the design of infrastructure, and so on and so forth. So basically, I see BII and other development finance institutions acting on the two sides of the supply and the demand of adaptation and resilience solutions. So enhancing the local availability of those solutions, but also fostering and stimulating and enabling, the uptake of those solutions, including through concessional capital. So for instance, to provide you an example, we work with one of our investees to basically adopt and invest in a mangrove restoration and rehabilitation project to be able to protect a wind farm located in Pakistan to avoid sea level rise related damages and also flood risk. And it was estimated that ultimately the investment enabled 1 million cost avoidance in maintenance, and very much do so over the lifespan of the asset, so 25 years. And I'd like to underscore that in the context of infrastructure, it's particularly relevant to consider from an investor standpoint the lifespan of the asset, not only the lifespan of the financial instrument that we provide. And this is particularly relevant for development finance institutions and impact investors, but beyond, because infrastructure have to last for the entire period for which they are built. And possibly to go back to the point that you were raising, Raffaele, how do we mobilize IFM and the like? Obviously, blended finance is a key tool to that end, but also I think the role that we have in strengthening the bankability of corporates and assets, including through the promotion and the building of capabilities, but also of high standards in the context of corporate governance, in the context of physical risk management, in the context of environmental and social risk management, you name it. I'll stop here for now.
Plenty there. Your role is key. I get to you, Simon.
Thank you.
So you've been working lately on the water sector in particular. Pity that the investor left the room, maybe for a reason. But tell us, how do you see these investment needs that the UK face going forward? How the resilience aspect of this investment is taken into consideration by the regulators going forward, and what are challenges you see?
Thank you. So thanks very much, Raffaele. As you said, over the last decade, I've worn a number of different hats. 6 or 7 years ago, I was at Macquarie, where we would invest in climate finance. But adaptation at that point was very much the poor relative to mitigation. All of the money was going into mitigation, funding wind farms, funding solar parks. And everyone talks about adaptation, but it almost wasn't clear what the investment needs were and therefore what the models are. So I think the questions you are asking now are all the right questions. Then I spent 4 years on the executive committee at the energy regulator, Ofgem, and resilience was one of our number one issues. When we had storms, electricity networks would go out, customers were affected, particularly vulnerable customers, and there was a realization that we needed to allow electricity networks to have greater funding to improve their resilience. And where adaptation comes in is, and we heard it so well on the previous panel, there is more flooding, there are more storms, and therefore there is a greater need for resilience, which unfortunately consumers have to pay for. And it's the regulator's job to allow efficient costs to be incurred. The regulators hate putting up bills, but there is this realization that there is value here for consumers in having a resilient network that is adaptable to ongoing climate risks. Which brings me to my current hat, where I'm a partner at Oxera Consulting, which is an economics consultancy firm, where we do a lot of work in all of these regulated sectors. And we've recently taken a deep dive into the UK water sector. And if you opened up your newspaper today, you'll have seen 2 adaptation stories in the press. The first one is Southern Water that you put up. Southern Water are reportedly entering into a contract with a firm in Norway to, in the event of drought and their reservoirs and their underground aquifers running low, they will actually ship in Norwegian water into Southampton, and then in a big pipe it up to their customers. So they're already looking at some pretty exotic contingency planning for drought. At the other end of the spectrum, and this is why the water sector is so uniquely vulnerable, climate change means we're going to have more flooding, but also more droughts. And both of those affect the water companies. So the other story in the press today, a good client of ours, Southwest Water, said that they will face financial penalties from the regulator because their sewage targets will be worse than expected because of all the flooding. And so with all the flooding, it overwhelms the existing sewage systems. And they pointed out that the last 9 months have been the 3rd wettest on record. So this is a sector that's really affected by these risks. It's a sector where you've got the regulatory tools and the funding tools through the existing regulatory asset base funding. So in other words, the regulator will put up bills for consumers. Those bills will be collected over 30, 40 years. And on the back of that, investors like IFM will invest in more capacity and greater resilience. So that there is an existing mechanism that can work well. It does require 2 things. It requires the regulator to have a shared understanding of the needs and applying the appropriate challenge, so there's enough investment but not too much investment. And then it requires the regulator understanding that we are in a global competition for capital. The UK water sector is just one sector in one country, and the global investment needs are huge. And so unfortunately, sitting here on behalf of UK water customers, we're a price taker. And it's very important that the regulator sets that cost of capital at the right number. So the study I did was I went and spoke to 30 investors, including IFM, and we looked to give the regulator some feedback about our views of tweaks they need to make to the existing regulatory mechanism to bring in that capital.
Thank you. Mike, how are we doing with time?
5 more minutes.
So there are questions. I think I would take it now.
My screen, can you hear me?
No, yeah. I think if you wait 1 second.
I just have a question on the scale up, because just building on what you were saying, Raffaele, about how challenging it is to actually get adaptation finance in the City of London. And then if I think about the work that Chiara does or that I do in emerging economies, if it's a challenge in London, it's going to be a really, really tall order in emerging economies. And obviously there's a lot of initiatives that DFIs are making, that international financial institutions. There's also a lot more impact investing, but part of the challenge is that it's quite fragmented and it's very project specific and it's sort of deal by deal. So just going back to the whole system and the sort of urgency of our adaptation needs for our food systems, for our cities, how do we scale and how do we really make that case for private investment?
Good question. There is any other question? Maybe we take another one. Yeah.
Yep. My question was about data gaps and product structures. So with a lot of adaptation financing, it has spillover benefits. So a municipality might invest in something and private companies and consumers will have lower insurance costs and reduced vulnerability. How do you think the data gaps that are required can be better filled? And with better data, what new types of product structures can you envision that could lower the cost of capital for adaptation-linked projects?
And last question.
Thank you very much. I would like to have your views on the emerging and developing markets. I know BII, for example, is in those markets, there is a lot of knowledge that could be shared. So my question is, how can we build on adaptation measures and make sure that those are also transferred in developing countries and making sure that they are actually learning and they don't follow the longer journey maybe we followed? Thank you.
So scale up. How do we scale up adaptation to the challenge we face, the data gaps and reduction of cost of capital in developing countries?
Do you want to start on to?
Yeah, Chiara starts.
Thank you. It's easy questions. So possibly on the data gaps. So first I would like to underscore that obviously models are essential, are critical, but they are not providing all the information that are required. So from an investor standpoint, what is critical, particularly during the due diligence process of an investment, is to engage with the investees to properly understand the vulnerability profile of the investee, which is very specific to the asset, the company that we are investing into. And these are type of informations that models are not providing, even though there are like vulnerability damages, vulnerability functions, but still they're not capturing the actual picture. And that also links to how to engage investees to disclose, their risk profile, and ultimately for investor and capital provider to price in the benefits of adaptation and resilience. Think about even like a bank providing financing to farmers. Physical risk and adaptation needs to be integrated into the loan origination and disbursement cycle, such that to incentivize climate smart farmers to have access to lower interest rate and potentially greater quantum of capital, and climate smart farmers cannot be treated in the same ways as farmers that haven't adapted to climate shocks and stressors. So it's very much kind of changing processes and procedures within investors and financial institutions, but also very much engaging with the investees through the due diligence process, being the due diligence of an investor or like a financial institution, to very much understand and provide, even advisory to the investees, what is needed, what is required, and support them and through bespoke products and services to update the solutions. And particularly in emerging markets, the brokering role of development finance institutions or other financing partners along the investment value chain is also to very much provide the advisory that can tackle the knowledge and capability issues that the investees with whom we are engaging cannot do in isolation.
Simon?
Right. Just in terms of scaling up, to give you another fact, we've heard so many big numbers today, but the current regulatory value of the UK water sector is £99 billion today, and over the next 25 years, for resilience, but also for more capacity, another 260 billion needs to be spent. So in other words, we need to invent, 2.5 water sectors over the next 25 years. So that is going to suck up a vast amount of capital. In terms of how you do it, you can fund through companies or you can fund through projects. I think we have to make the UK work really well, and then I think it will create exemplars of structures that work that can then be applied in other countries with appropriate changes. But the truth is we're perhaps not doing it as well even in countries like the UK. And as I say, I think we have to get that right, as well as then creating approaches that can be applied in other markets.
Okay, thank you very much. I'm not sure we gave exhaustive responses to the big questions that adaptation is facing at the moment, but that's the beauty from a research side of it, which means that we need to study more, we need to do more research. There is more data needed, of course, but there is also new opportunities, hopefully came out from this short conversation. And if you want to engage with us on this work, please let's talk. Otherwise, please join me in thanking our panelists.